Before you buy a stock or a fund, take 5 minutes with me and run this simple 9-point check. It won't predict the future, but it can help you avoid the obvious landmines and spot the quiet winners. Hook over. Here's the checklist. 1. Business fundamentals. What does the company actually do? How does it make money? Is the model clear? Scalable? Sustainable? Are they a leader or just a small player? Do they have a moat, brand, patents, network effects, and will people still want this in 10 years? 2. Financial performance. Look for steady revenue growth, operating margins, net margins, ROE, ROCE, debt reasonable, interest coverage strong, free cash flow, positive and consistent is the lifeblood. 3. Management quality. Great business, bad leadership, that's a problem. What's the track record of the CEO, founders? Any governance red flags, fraud, accounting games? Do they communicate clearly in annual reports and earnings calls? 4. Industry and economic outlook. Even good companies struggle in shrinking sectors. Is the industry growing? AI, EVs, green energy, regulation, geopolitics, supply chains? 5. Valuation. Compare PE, compare PB, compare EV/EBITDA. Use the PEG ratio to balance price against growth. Ask, what's intrinsic value versus the current market price? 6. Risk factors. Where can this break? Over-reliance on one product. Over-reliance on one market. Over-reliance on one customer. Lawsuits. Regulation risk. Currency swings. Commodity swings. Interest rate swings. Tech disruption from faster competitors. 7. Growth potential. Seek consistent, realistic growth, not hype. New products, new markets, smart acquisitions. Is there a long-term vision and investment in R&D to back it up? 8. Dividends and shareholder value. Stable or rising dividends can signal maturity and discipline. Buybacks can be great if done at reasonable prices. Check that payout ratios are sustainable. 9. Time horizon and your goals. Match the pick to your risk tolerance and timeline. Long-term investors can ride short-term noise if the fundamentals are strong. Let's apply it quickly. Imagine evaluating a large IT services company like Infosys. You'd look for steady 5-year revenue growth, 5-year profit growth, strong ROE, around 20% or more, strong ROCE, around 20% or more, low debt, healthy free cash flow, competent management, global demand tailwinds, and a valuation, PE versus peers, that doesn't stretch reality. If the boxes check, it could be a solid long-term hold. Here's the takeaway. You don't need to predict the market. You just need a repeatable process. Save this 9-point list. When a stock tempts you, slow down, run the check, and let the numbers and the narrative agree. If this helped, share it with someone who buys stocks on vibes. And remember, patience compounds.